So this is going to be a short and sweet event. First of all, we got Halloween. We need to go on out and earn some candy. And hopefully this trade is actually going to maybe be more of a cavity than a candy, right? Because we're going to look at a scenario and say that it goes against us. A lot of people know what they can do when the market goes with you. But in this instance, what do we do when it goes against us? And I actually put this or had this sent out in the email, or in the, I should say, the marketing email that went out, this isn't a perfect hedge. The one thing I love about the hedge that we're going to talk about is that we're not going to add any additional risk to the trade, and it's not going to cost us any money. But when we're all said and done with this trade, all we got is a chip in a chair. And if you've never played poker, you might not know that reference, but there was a person that was in the World Series of Poker that had a chip and a chair, and that person came all the way back and ended up winning that tournament. And that the quote was by that person saying that, if all you need is a chip and a chair and you still got a chance. And that's the way that I approach this trade. My attitude on it would be that, another way to say it, just a lot of little fun little analogies, is I don't want the cheese anymore, just let me out of the trap. Okay, so I'm probably going to be doing some of these in the daily play, inside the options play, after the stranglehold that this election seems to have on the marketplace right now. And as we're going into the end of the new year, we just had a real big week because all the Mag 7 announced, well, not all of them, but most of them announced this week. Amazon just announced earnings right now. It looks like the stock is up a little bit. I obviously didn't have a chance to really look at it. And Apple is also announcing earnings today. So with that said, the holiday season is coming. The election is coming. Let's get this stuff out of the way. And the way that I like to do my trades, if I want to get bullish on the marketplace, is to look at the S&P 500 index. And I prefer this over the SPY because that's going to be a question that I'm going to get. And the main reason, there's a couple of reasons behind it, is first of all, the tax advantages of trading index options, the 60-40 rule, if you're not in a retirement account. Now, you can do this in a retirement account if you get approval from your brokerage firm. And on top of it, it works better with higher priced underlying stocks or indexes. And part of the reason why is just the dynamic of the fact that if we're looking at a spread, and let me introduce the spread to you, my long call spread in the SPX that I set up today. Actually, I used Monday's quotes, but I set it up today. Yeah, I did this. Yeah, I used Monday's quotes. I had a screenshot of it. Okay, so in that instance, on this Monday, on the 28th, the SPX was at $5,834.85, and the VIX was stubbornly hanging around that 19% level. It's up a little bit more today because the markets got ugly. But with that said, we bought an in-the-money call option and at the same time sold an at-the-money call option. Now, I like this in that you're selling more premium than you are buying. In other words, this option contract right at this point in time was 15 cents out of the money. So this is all time value.